Hello, xin chào tất cả quý vị. Hi everyone, my name is Longley. Welcome back to this brand new episode. In this show, we are going to talk about a couple real estate investment tip. Specifically today, I am going to share with you a couple way for you to calculate whether it is an investment, it is a good investment or not. Because I know that nowadays, lots and lots of people are interested in doing real estate investing because of how crazy the real estate market nowadays, right? So in this episode, I am going to tell you some calculation because if you just go look for a house, right, how do you know whether it is a good deal or not? So in this episode specifically, we're looking at the strategy that if a investor buy a home, hold it, and rent it out. Okay, how do we know whether it is a good idea or not? Okay, it is a good deal or not. So let's take a look at what we have to be able to demonstrate this. In this video, I am using an example right here. So let me share my screen real quick. And I have a property, an example property right here. Just get onto the market in um, just get onto the market about an hour ago, maybe probably more because now 2 hours ago, right? Located in Chandler, Arizona, beautiful home, 3 bedroom and 2 baths, 1,300 square feet, and unfortunately only 4,000 square feet lot, right? But hey, this is for you to rent, okay? And for the renter, in the eye of the renter, most of them, not all of them, right? Most of them don't care much about the square footage of the lot, as long as you have a beautiful home. Look like so far we do have that check, right? So you have looking at the picture right here, it is really encouraging for you to go check out the house and look at the beautiful community as well. Some of you may think, wow, the HOA may be expensive, but hey, only $40 a month, so it's very reasonable. Okay, and then I think it's gonna make a good deal. So let's check it out. Okay. So the price is 410, right? To be able to do the calculation whether it is a good deal or not, we do have to do some calculation, right? Otherwise, who knows whether it is a good deal or not. All right, so let's demonstrate a little bit. Let's say if you purchase the home at 410, okay, 400,000. Let me move myself away here. Oh, too small. Yep, there you go. It's better. Okay, so if you buy the house at 410, right, and then we do 20% loan, okay, I'm gonna do another calculation very soon as well. Let's do 20%. Let's do 25% loan, okay, because normally if you as an investor, if you take on a loan, 25% gonna give you the best rates, okay, so 25%, which is about $102,500 down payment, okay, which means you're gonna take on a loan of 307, okay. 307. Now I already do a research. Now one of okay. First of all, let's do some calculation here. Okay. So let's say that means if you do, there's a lot of mortgage calculation by the way. But if you search on the Google, you're gonna see right away. If you do 307,500 is the loan. So your mortgage monthly payment is gonna be 138,081. Okay, so that is this orange check right here is your mortgage payment, including only principal and interest. Okay, assuming a 3.5% interest rate. That is the rate for the investor. Okay, all right. So that is actually the first expense that you have to do. Okay, and then I do have a list of all the other expenses here. Okay, we have to talk about taxes. Okay, we have to talk about insurance because those are the things that you gonna be is gonna be a must, right? You cannot not paying tax. You cannot not having insurance. You technically you could, but is the risk is very high if you lose everything. And plus that you since you're taking on a loan, you will be required to have a insurance, right? Water, sugar, and garbage, assuming that the tenant is gonna take care of that, so you don't have to pay anything. Electric, similarly, you don't have to pay anything. HOA for this case. Oh, by the way, some of you may ask, hey, Long, how are you gonna be able to get those information? Okay, this information right here is located right here on the website. Okay, $40 per month for HOA. And if you scroll down here, there is actually a calculation. And don't worry about this assumption here. They may use different assumption. So the other assumption that I use is 3.5, a little bit higher rate because we are we are doing investing, right? This is 20% down payment as well. So you're gonna have a lot of difference here. So don't worry about those. Mainly focus on the property tax and the home insurance. Those are the estimated number. Okay. So this is monthly. So you enter here 107, 103, 440. So these are what I call a must cost. Okay, it's a required cost. You cannot run the business without these. These right here is optional. Okay, the green one here is optional, and the mortgage also another thing that it is the must. Right, we already talked about it. So we have a target mortgage must here, tax and insurance, water, sewer, and garbage and electric, natural is a must, right? So those are all the expenses that we have to spend every month. Okay. Now you as an investor, when you do this calculation, you have to do that. Otherwise, you have to calculate monthly. You have to calculate yearly. I'm gonna show you what I hide here, so that you know more information here. But we'll see. Okay, the monthly rent of this, I already checked the rent for the area is about 1950 for this property. Okay, 1950 for this property. All right. All right, let me show you one piece of information that I hide. Zoom 100%. It's gonna be small a little bit. All right. Okay, let me show you that. Okay, so we have a total income. So this is total income versus the total expense. Okay? The total mortgage is the red cost, and the total expense is everything. Okay, including the red and the green. Okay, some of you, the reason why I want to highlight this is that some of you might think, okay, the mortgage, some of you only calculate 1630. Okay, and then you say the total income is 1950, and therefore, hey, I have money every month, right? No, you're not, because you don't calculate for those green those green expenses, right? Those are not the required, but you do have to account for them. For example, vacancy. What if the property gone vacant, right? So you do have to calculate for the vacancy here. What if the tenant call for the repair? So how are you going to be able to prepare for those repair, right? The only way that we can do that is to allocate a portion of your income to the repairs, right? And normally the way that I do is to do 5% of the monthly income, of the monthly rent, and then just do the quick estimate, right? The thing that is more difficult to understand is the capital expense, okay? Capital expense, okay? These are the thing that is bigger, more expensive, right? We're talking about the roof, we're talking about the AC. What if we have to replace the AC, right? What if we have to replace the roof? Those are the things gonna be very expensive, and we do have to account for those. Now, this is a quick and easy way, quick and dirty way, quick and easy way to do the calculation. Do 10% of the monthly income, okay? But in another video, another episode, I'm gonna talk more about how do you calculate this in a more accurate way. This is just a quick check so that you can get a feel whether it's worth the time to invest or not, okay? But of course, in a contract, you do need to, I would highly recommend you to do more depth calculation, more deep calculation, okay? Management fee, if you, again, since this is green, right, you don't have to, but this is highly recommended. Otherwise, you're not going to be able to have free time, okay? So about 10%, those are the things, okay? The other thing is like the down payment here, we already talked about that. Repair cost, assuming looking at the picture right here, I don't think that I have to spend a lot, even none, right, for the repair, because the tenant is pretty much be able to move in right away, okay? Loan cost, this is because you take the conventional loan, so it's about $6,000, right? So the total investment is going to be $108,500. These are the money that you have to spend. Okay, these are the money that you have to spend. Don't worry about this yet. Don't worry about this yet, and I will show you later. Okay, so now I'm gonna show you everything that I hide here. Okay, so on this chart right here, you have a total cash flow. Okay, now this total cash flow is actually the difference between these two numbers. Okay, is the difference between those two numbers, because this is total expense. Okay, I would not do the total mortgage minus total income, because in that case you're going to have a positive cash flow. But that is not all the expense that you are going to spend if you own the property, right? So this number right here is more accurate. Okay, so for that reason, this is a negative cash flow. Okay, so for every month, well, this is incorrect because this should be a year. Okay, sorry, nope. So for every month, every month in the first year, this is year number 1, and this is year number 10, right? Every month for the first year, you lose money. Okay, and then for that reason, the return on the investment is the total is this number right here divided by this, because since you lose the money, right, it's a negative number, so it's negative 3%. So obviously, if something happened, okay, in this situation, okay, if everything go good, okay, if everything go good, and also therefore you don't have to spend that much money, right? 0, 0, 0, 0. Then you have positive cash flow, as you see here, because the total expense is equal to the total mortgage, right? You have positive cash flow. But in the ideal world, you wouldn't do that, right? As an investor, you have to account for those so that you can have the money as the risk appears, okay? So those are the things, those are the reasons why you have a negative cash flow for every month of the first year, okay? Now the next calculation come to you. Obviously, this is not a good deal if you're only looking at the short term, right? For the long term, you still have a negative cash flow, okay? You still have negative cash flow. You cannot have a positive as long as the expense going to be the same and the total income going to be the same, right? So you're going to have a negative cash flow as well, and anything could happen, right? So for 10 years, you lose that much money, okay? You're not going to be able to have because these are the money that you have to put maybe of your own cash into the saving account, so that if anything happened to the property, you will be able to use that money. So you lose the money again. Luckily, that after 10 years, assuming the value of the property go double. The reason why I do this is that when I'm looking at the chart here, right, from 2016 here, 2016 here, is about 200. The value is about 200, now 400, okay? So luckily, you have a positive percentage after 10 years, okay? So those are still a positive number if the value is going 10 years after this. This again, very risky, right? But those are all the things that I want to share with you. This is how you looking at all the calculation. If you want a copy of this sheet, feel free to message me, and I will send it over to you. Thank you. Bye bye.